Welcome to our webinar. To kick it off, to give you some context, things are tough for some people right now. Life is a challenge for many people when they are stuck in the same old routine of paying the accounts or their bills. I call it the salary treadmill. They're working hard, they're working 9 to 5, but many of them cannot afford or cannot manage a holiday break because the debts keep growing bigger and bigger. You know, we all joke, you know, we're going on holiday, no, we're going to Romania. We're going overseas to Eastern Europe, no, I'm remaining here. That's the one joke we always hear, and the one recently I heard is, I'm going to the garden route. I go, oh, awesome, which part? No, there's no such field. And they say, no, my front garden or my back garden. Okay, so the thing is, people do not budget because they feel too broke to budget. That's number one. And number two, you know, many people simply hope that things will magically work out. And I always say, hope is not an investment or saving strategy. So financial stress does not come from running out of money, but rather is a result of not knowing how to manage your money well. And so one thing that all millionaires have in their mind is that they always manage their money. So keeping track where money goes is an essential key to financial success. And of course, while money cannot buy happiness, having more money can really make life a bit easier. The other day, someone said to me, money is not important. But I said to him also, you know, money rates up there the same as oxygen. Okay, so remember that spending money is not as important as keeping money. And if you do not have any idea on how to start planning your budget, obviously through this presentation, we talk about the 6 money jars method. It's suitable for everyone, no matter how much money you have. Money does not buy happiness, as I mentioned just now, but it can buy freedom of choice. Okay, so good afternoon. My name is Sean van den Berg. I'm investment specialist here at PSG Wealth. I hope to discuss why budgeting is important. Obviously, that's the whole gist of this presentation today. But more importantly, you know, why budgeting helps you control your spending, helps you track your expenses, and also help you to save more money. So I always look at it this way, and I love this topic because you basically become your own financial planner, your own money manager. That's the real basics of it. So additionally, budgeting can also help you make better financial decisions. So it also helps you to prepare for emergencies, helps you get out of debt, but also helps you stay focused on your long-term financial goals. So some of you might have heard of a guy called Dave Ramsey. There's a quote from Dave. He says, winning at money is 80% behavior and 20% head knowledge. What to do isn't the problem, doing it is. So most of us know what to do, but we just don't do it. If I can control the guy in the mirror, I can be skinny and rich. Okay, so I might be talking to or preaching to the converted today. Let me just move it. Here's my agenda. So yes, I am talking basics. We talk about budgeting, but the way I look at it, it is fundamental. That's some fundamental principles we'll be talking about. But also, I believe that hardly anybody or most people do not use these principles. Hence the need for this presentation today. Okay, so you can see that's my agenda today quickly. As I say, this presentation is being recorded, and I'll be sending out the presentation recording as well as the PDF of this recording. And the idea is I hope you also be able to share it, especially those who have children, share it with those people that also might need it, just to think better about their money situation. So I know from personal experience what it's like to make excuses. Okay, when I need to change something in my life, I spent lots of years, I refer to it as my reckless youth as such. You know, that stage in life where you're all knowing, all wise stage in life. As I say, I call it my reckless youth, where I was languishing financially because I did not make the effort to take these steps. So I'm talking from experience here. So I've learned to do this. I've gotten to the stage now where I start anything, it's much easier to keep on going with it. You know, create a routine, create a habit. You know, I don't make excuses anymore. I learned to just do it. Take action. And that's also what's important today, is to take action, stop procrastinating. So action is what gets stuff done. So here's 5. There are a lot of excuses. I've just taken 5. But basically, the most common one you'll hear from a lot of people is they feel too broke to budget. It can be scary to write down all the money you're going out of, all the money you have going out each month, and realize that you do not have enough cash flow to cover it. That's number 1. And number 2 is that many people forgo a budget and simply hope, as I mentioned just now, that things will magically work out. If you're in this situation, it's essential that you budget so you can make the best choices with your money. So budget can also obviously help you see where areas we can cut back and make choices to change your situation, and obviously free up some much needed cash. So that's number 1. Not having enough money as such, but as I say, this is applicable for anybody. It takes too long, or it's boring. And budgeting is the first step. You're sitting down and you're going to sit down with your expenses and your income. You want to create a good budgeting system. We'll talk about it a bit more later. I use the Excel spreadsheet monthly, and I just copy and paste obviously to the next month, but I know exactly what's happening with my money. So many people make enthusiastic budgets and then they lose their motivation. So the whole idea here is to just change your mindset. You're changing your mindset instead of looking at this as restricting your spending habits. Just look at it as a way of changing your habits. You're starting to get excited at by adhering to a budget. You're going to be on a pathway to achieving your financial goals. So that's if I may just throw it in there. It's just that change that mindset. That's where it all starts. I don't like to track my spending. It's a hassle tracking the spending. I just find, and I'm with Capitec, I find that the Capitec's banking app is very useful. I personally also prefer to use a debit card. I hardly ever use cash. I hardly ever draw cash. But the whole idea why I use the debit card, I can see where my money is going, and I can categorize it. There's a little budgeting app you can use. I can categorize where the money is going to. So it's a nice way to track. So it's very, you can set up it as an automatic thing for yourself. So we'll be talking later on about the envelope method, but basically, especially for the younger children, if you want to give them pocket money, you're using cash for them, use the envelope method for them. Okay. So it helps you stop blowing your budget. If you have in cash and then little envelopes, if you spend that money in that envelope and that money just for groceries, and you've gone past that, and you have to start digging to other little envelopes, you're going to run into problems some sooner or later. Okay. So just be aware of those kind of things. Then budgeting makes me feel bad. I always say, why does it make you feel bad? Because you might have those feelings of deprivation, this feeling of lack or scarcity or denial. And I always say it's like dieting. To have an effective dieting plan, make I always say, make room for a chocolate once in a while. Make it a little reward. You have to be a strict diet which create lettuce leaves the whole time. So make it fun. It doesn't have to be strict and things like that. Make it fun. So the main thing here also, I think the biggest problem for a lot of people, they don't set realistic goals, and this is one of the most common reasons why budgets fail, is because they set unrealistic goals. While every reasonable budget aims to cater for your financial history, your needs, and your goals, it can be tricky to expect your budget to solve all your financial problems. Okay, so the whole idea about budgeting is it's all about long-term planning. That's number 1, and number 2 is also helps you, as I say, track your spending, your paying your bills and your accounts, but also it helps you to start, as I say, consistently putting away set amounts of cash every month to deal with unplanned emergencies. We'll talk about the emergency fund just now. And I know I have in previous webinars discussed how to create a emergency fund. And I'm going to hop on it again. So the main thing is also, a lot of people, I use this expression sometimes, where they're living the champagne lifestyle on the beer income. In other words, they're living on credit, they're living above their means. And I think lots of more people are getting into trouble because of that right now. So if you're in that situation where that's a big problem, number one, stop digging your hole. I suggest you take a credit card and you cut it up. Don't put it in the safe or anything like that. Cut it up so you don't spend any more money on it. So stop digging, no more debt. And then obviously, as I say, cut up those credit cards. Don't use those things. Okay. So the whole idea here, and it's to set smaller goals, and that's what this whole presentation is about today. We'll talk about your goals. So as a strategy, the goal is to practice moderation and saving and spending, number one. But also, I believe that one of my goals is to live what I call a rich life. Now, my definition of a rich life is being free from financial stress, that having that peace of mind. That's number one. And basically, it's just being in a situation where my life is filled with things that gives me pleasure. So it doesn't have to be the 10 million rand house, doesn't have to be the 2 million rand car. It's life experiences. That's what I enjoy. Time with my family, etc. Okay, so here's some strategies that help you just set your mindset. So remember, the importance of making a budget is the financial lesson, and I can't overemphasize this. It's a financial lesson that budgeting does. So why budgeting? The main idea is to create that financial stability. So it gives you that stronger financial footing, obviously for the day-to-day running of your called bank account, but also it helps you in the longer term. So as I say, here's some methods that you can think of why budgeting is important. It helps you keep your eye on the prize. So as I mentioned again, it has long-term goals and helps you to work towards them. Instead of just being on like a ship on the sea or a yacht on the sea without a rudder, instead of just drifting around aimlessly, now you're going to have something to work towards. So budget forces you to map out your goals. It helps you it forces you to save money, track your expenses and things like that. And I always say start with why. It's old, I can't remember his name now. There's a book called Start With Why. But ask you these questions. Why is budgeting important to me? And then you'll find a lot of things. So it helps you ensure that you do not spend money you do not have. Having I mentioned just now, that's having that champagne lifestyle, living on a beer income, living above your means. So this forces you to live within your means. And we'll discuss some budget strategies just now. And helps you prepare for those emergencies. And this is where we're going to talk about it a bit more in detail just now. But the whole idea is to, again, be in a situation where you have 3 to 6 months money set aside. Something happens, you got that peace of mind that you don't have to dig into your investments. You don't have to stress. You can sleep well at night. I always call it what I call the swan. Sleep well at night. But also, it helps you to work towards that happy retirement. The earlier you start, and you can use the magic of compounding, the better. And we have discussed this also in previous webinars. And then obviously the main thing there is to shed light on bad spending habits. Mentioned, said now you've been in a situation where you can sleep well at night. Following a budget will also help you catch more shut-eye. As I say, it gives you that peace of mind. You're in control. You worked hard for your money. Now you want to have your money work hard for you. So this is what we're talking about here. So this is just the tip of the iceberg. There are a lot of other strategies you can take into consideration. So here's call it 6 budgeting methods to consider. We can, before I get into it, before picking any new or different budgeting method, you might want to figure out where your money is going. So this is the basics of budgeting. So you know what areas you need your attention on. Obviously, spend on your money where you're spending your money on. if you're spending too much money on entertainment, it's great to spend money on entertainment, but budget for it. That's number one. And obviously, the whole idea is that you want to set aside your receipts for the last 2 or 3 months, and then put them into little piles, little categories: piles for food, piles for transport costs, be it petrol and oil, time, the stuff you spent on entertainment, how many times you go out to the restaurant, all those kind of bills, etc. But that gives you a better idea of your current spending, and also provides opportunities. We can find ways to adjust and perhaps obviously save. So you can either do that to slips, or, as I say, I prefer to use my bank statement, and I can see where the money's going. But also, as I say, with the app, there's a budgeting tool on that. Okay, so most people, I believe, would be using what we call the zero-based budget, or I call it the balanced budget. What is that? Basically, the concept here is just very simple. Your income minus your expenses equals 0. So this budget method is used by people that have a set income each month, or at least can reasonably estimate their monthly income. So I think a lot of people will be in that situation. So after calculating their monthly income, they add up their monthly spending and savings, and that equals obviously the income. It's important to plan out all your expenses as accurately as possible, especially with this method. So the challenge here is that it might be time consuming. It leaves you less room for error. If something happens, especially what's happening right now, the cost of living going up. We're seeing our fuel prices going up. I remember once upon a time with my car, I had to fill up, it cost me 800 Rand to fill up my car. Now 800 Rand, it gives me half a tank. And I think lots of people in that same boat now. So you have to spend more money on those kind of things. So you have to make a leeway for that, make allowance for that in your budget. And that's where, call it a buffer. You need to have some extra cash in your account. But also now with interest rates going up, we saw that interest rates went up 75 basis points, 0.75% last week. My bond alone has gone up $400. So imagine all of those people that have car payments and credit card payments, how much more of your discretionary income is being taken up by those kind of things now. So again, it's very important to have a smaller emergency fund, especially for unforeseen circumstances, but also to have a buffer in your bank account. So that's what we call the zero-based budget, is your income minus expenses equals 0. And then pay it yourself budget. This is what I call a surplus budget. This is for some people that have that extra income. And we talk about pay yourself first just now, but this is someone that wants primarily focus on savings and debt repayment. So that's what I mean by this situation. So you want to focus on paying off high interest debts first, your credit card payments. So say stop spending more money on it, cut it up, and then obviously build up that emergency fund. So the main thing here is, this is not this is a budget for someone that struggles with saving each month. And the best way to do it again is to change that mindset, pay yourself first, and then everybody else. Okay. Now let's talk about the budget deficit. And I think this is where many people are sitting with right now. The opposite of the budget surplus is the budget deficit. Debt is the amount of money that's owed, and a deficit refers to obviously your expenses being greater than your income. In other words, I'm referring to those people that are spending more than you're making or earning. And I think lots of people in that boat right now. Okay, so there's 2 ways to reduce your budget deficit. You either have to increase your income, or you have to decrease your spending. Okay, so yes, again, your budget will help you highlight the areas where you can cut back on those unnecessary expenses. You don't need DSTV and Netflix and Disney Channel and Prime Video, etc. Yeah, cut back on that. You might want to be, you're spending money every day buying at Starbucks coffee. Cut back. It must be small amounts, but it adds up on a weekly basis. Then on a monthly basis, it adds up. You start saving $500 here and there. Take that $500, get rid of your debt, and starts compounding. Okay. I always say, your credit card debt pay for credit card debt because it might have an interest bill of 24%. You pay off that credit card bill, you're saving yourself 24%. It's the same as making 24%. Okay, so that's my the deficit budget. As I say, you need to find ways where you need to increase your income, either get a salary increase or get a pay increase or find a better job, working 2 jobs. What a lot of people are doing, they're selling some of their assets. When I say assets, they're selling those bicycles they don't use, or that extra furniture they got in their house, or the extra microwave, or the extra, whatever the case might be. Using that now, you can even have a garage sale and get rid of some of that the debt you might be having. But you also some people might be considering starting a side business, side hustle, and also renting out the property. These are all different ways of increasing your income. Okay, let's talk about the envelope system. This is very basic one. This is where it's very similar to the zero-based budget, with one big difference. Obviously, you do everything in cash. So I don't think a lot of people use a lot of cash nowadays, but the idea here is that you're going to take, you plan out all your spending, and you're going to put that money all into different envelopes. And as I mentioned just now, you spend that envelope for groceries, that's the money available for groceries. If you go over that, and we've seen now the cost of living, we've seen the food prices have gone up. So yeah, you have to be aware of those kind of things right now. As I say, I prefer to use my debit card if I can only spend money what's in my account. Okay, so then we talk about the 50-30-20 budget. This is a straightforward budgeting method. It requires less work than the zero-based and the envelope budgets. The idea here is just to break down your expenses into 3 categories. Your necessary expenses is 50%, your discretionary expenses is 30%, and then savings and debt repayments is 20%. So this is a great option for newbie budgeters because it doesn't require meticulous tracking of all your expenses. So it's more, call it someone that wants to, work on your wants and your needs. Could talk it that way. It helps you towards savings and getting rid of debt. So the main big drawback, I would say, of this this method is that it's unrealistic for people that have a lot of debt, or people that have big savings goal, because 20% isn't a lot. Okay, so that's just be aware of that. So in other words, don't get stuck on the 50-30-20 proportions. Okay, and that also, well, that leads up to my 6 money jars, the money method, and this is what I use a lot. So basically, I have discussed this before in previous webinars. We talk about the 6 money jars. It's just a very way of looking at it. It's just having 6 money goals. Call it that, 6 money goals. And I want to highlight for you money management system. Okay, so it's probably no surprise that individuals with documented or written goals are far more likely to achieve success. So this is just a way of documenting where your money is going and planning for that. So having goals is great, but without implementing the plan, and I'll go up on it again, you might not get there. So again, the reason why I like using this method, it's not having the perfect plan, it's having many goals to work towards. So it's just being flexible, So first of all, this is me personally, and in this example, you can see the 6 money jars. You got 6 jars. One's called give or tithing. One is called financial freedom account. One is called necessity. One's called education. One's called long-term savings. And then one is called fun or play. So me personally, I like to give 10% of my income as soon as it comes in. Whatever income I get, I give it to charity. But in my personal situation, I like to give it to my church. I call it first fruits, tithing. But some of you guys might say, okay, I want to give to charity. I also give to Cotlands. I also support the SPCA, the Anti-Animal Cruelty League. There's the various charities that you can support also. But basically, you want to give your first 10% away, give it away. And there's obviously some principles involved in that. So that's number 1 for me. And number 2, And I mentioned just now, you want to say to yourself, I want to pay myself first. Before I pay my creditors and things like that, I want to pay myself first. So that's where this financial freedom account comes into it. It's your golden goose. Okay. This is your ticket to financial freedom. It's a very important jar, this one also. So this is where you put this is what you're going to use for building passive income. This is your investments. You're going to build passive income streams. You never spend the money in this jar. This is forever savings, call it that. Okay. You never spend this money in your financial freedom account. So this is, as I say, again, I've got to harp on it. This is going to help you become financial free. You know, the only time you ever dip into this is when you are financial free. We'll discuss it just now again in more detail. So, you know, you might want to put some money aside for education. And I personally like to put 10% away for education. This is further education. This is not your children's education. This is your personal further education. You want to increase or improve your skills. You want to improve, I use it for personal development, my mindset a lot. But I also spend a lot of money on buying books and courses and things like that, attending seminars on investing and trading. So that's what I'm talking about here, is putting your money taking money from your purse and putting it in your head. That makes sense. So here's a quote from Jim Rohn. He's one of my mentors I like to read more about. It says, formal education will make you a living. Self-education will make you a fortune. Okay, so that's the point of this education account. And here's another quote from Jim Rohn. Don't wish it was easier. Wish you were better. Don't wish for less problems. Wish for more skills. Don't wish for less challenge. Wish for more wisdom. Now, you can only get wisdom, obviously, from knowledge. And applying that knowledge and gaining experience, be it good or bad, that's where it comes from. Okay. And then obviously put 10% into what we call long-term savings. This is where you have a separate savings account. Now, I know that, for example, with Capitec, I've got my normal savings account and I've got 4 additional savings accounts. So I've used those for these kind of things. So number one, when you first start working, especially the young people, I believe that your first goal is to create an emergency fund. 3 to 6 months of living expenses, that's your first goal. But there's also the idea here is to have those nice to have purchases. Instead of going to buy that big plasma or LED TV on your credit card, save towards it. Okay, again, you can split this long-term savings. You might take 10%, but you might just for your emergency fund initially. But then you can also break it down a bit further. You know, have 5% for your children's education, whatever the case might be. But use it as a mini goal. And then lastly, as I said just now, you worked hard for your money. Now you want to enjoy your money. So set aside 10%. This is where you're going to nurture yourself. This is where you're going to buy that expensive wine once a month, or that nice bottle of whiskey, or a weekend away with your wife, or go for that nice Thai massage. Yeah, I'm planning to very soon take my whole family on a hot air balloon ride here in Lanseria very soon. Early morning hot air balloon, watch the sunrise come up, have some champagne breakfast, etc. Okay, so those are the 5 jars that you'll be using with 10%. Then you can obviously have 50% set aside for necessities. This is where you're going to have for your bond and your telecom bill or your phone bills, your food accounts, etc., your groceries, your transport costs, and things like that. So the idea is to keep it to 50%. So I hope that makes a bit more sense to you guys. As I say, look at it as many little goals. Again, you can split these up a bit further, like especially those long-term savings. You know, you might say, okay, 10%, 5% is for this, 3% is for this, and 2% is for that. Save up for that long-term holiday, that European holiday, etc. Okay, so that just gives you some, call it guidelines or some ideas. Okay. How to put this all into practice and obviously get it to work for yourself. While this is, your goal is to be financially independent, you won't always just be free, just putting money aside. You need to change that mindset. So you don't just want to be controlled by, be controlled by money. You want to be able to do what money allows you to do. In other words, money is a tool. It helps you attain things that will make you truly happy. That is what I believe is true financial freedom. Okay, so there are 3 steps to call it achieve financial freedom or financial independence. First of all, create assets that generate cash flow. Number 1, and number 2 is obviously be in a situation where your assets now pay for your living expenses. Then once your cash flow is greater than your monthly living expenses, then I believe that you are truly financially independent. So another way of looking at this is this little, call it from a little flow chart. This is how you can plan your cash flow, how to create that passive income for yourself. But it starts off here. Number 1 is your income sources. So most of us in a situation where we're working for a salary. We're putting our money every month, be it from our salary or from our job. Basically, it's your take-home salary. Okay, so from there is your income less your expenses. We spoke about those 5 or 6 money jars now. Okay, what's important is that, bring this little cursor in here quickly, is that one there, your financial freedom account. Okay, so your income minus your expenses will give you your financial freedom account. Okay, that there. That's why you want to get this to build bigger and bigger. So you're going to set money aside, as I say, forever savings. So you're going to set it aside. And in today's context, we're going to talk about dividend shares and property shares. Obviously, you can go, this doesn't take a lot of time. This is low effort. You might go one step further and say, okay, let me start building up a portfolio of rental properties, but it's managing those properties. You might be in a situation where you buy them, fix up, and you flip them. To me, that takes a lot of time and effort. You also might start a side business. Again, it takes a lot of time and effort. So this is what I want to focus on today. But the idea here is that you're going to set aside money and you're going to get the money to work for you, and it's going to create that what I call income generating assets. It's going to produce some passive income, and that passive income gets reinvested back here. So this now becomes another source of income. Okay, and you're going to be in a situation where this grows every month, in a situation where I don't have to work for a boss anymore. I don't have to work for a salary because my passive income is greater than my monthly expenses. And that, as I say, is the route towards achieving financial freedom. So I hope that makes sense for you guys. Okay, so let's talk about those investing for income. And we talk about investing using dividend stocks. And then I'm running out of time here, people, but forgive me. So first of all, income investing involves building a portfolio using, as I say, dividend-paying shares. You can also use it for rates or property stocks. The main idea here is it's a buy and hold passive investment strategy at its best. So what are dividend stocks? Basically, these are shares that are growing and obviously have enough profits, and dividends are being paid out twice a year. That's most of the time what generally happens, twice a year. We'll call it biannually, be it interims and full year. And obviously, as I say, it's based on how well a company is doing. So in other words, you're buying into companies that are growing. That's number 1. And number 2, just understand that there are 2 kinds of dividend paying shares. We have what we call the ordinary shares and we have preference shares. So ordinary share was obviously, as I say, these are dividends that are decided by the board of directors. They are decided most of the time by twice a year. You won't know the amount or even if there will be a dividend until the board of directors declare them. So just be aware of that. Then we have preference shares. Preference shares are more regular. There's a predetermined fixed payments of a specified period of time. So preference shareholders, the advantage here is that if there are any dividends, they'll receive their dividends first before the ordinary shareholder. Just be aware of that. But the ordinary shareholder, we're taking on more risk, but you also have more to gain. So a preference shareholder, they're less risky, but obviously the preference as such is usually lower. Okay, so just be aware of that kind of stuff. So the most consistent dividend-paying stocks, so these are the big blue chip companies been around for a long time. In other words, these are the large, well-established companies been around for a long time, to your household names, etc. So How do you know if a company is a good dividend paying company? One way to look at it is not just look at the earnings per share, that amount per share value, but also look at the dividend yield. What is the dividend yield? Basically, it's the company's annual dividend divided by the share price as a percentage. Yeah, so multiplied by 100. So, the average on the market, I would say, is about 3% dividend yield. So you want to look between 3 and 6%, even higher. So this, the whole idea of this ratio, it indicates a decent dividend payout relative to its company's earnings. Obviously, its market valuation, but also you want to avoid companies that are borrowing excessively to inflate their dividends. So the next slide, I'll go into a bit more detail. How do you pick the best dividend paying stocks? He has 11 criteria you can look at. I'm going to just touch on some of them. I've already touched on that current dividend yield percentage. As I say, the average of the market is around about 3%. Some companies are not paying out any dividends and reinvesting all their money back into the business for future growth. As I say, the more mature companies are paying out dividends. There's that old saying in the market: elephants don't gallop. So you might not be getting your 50, 60% capital growth every year, but you're getting it dividends coming in, steady income all the time. So main idea, you want to look for companies with a long dividend history. So these are the companies that pride themselves on having continuously paid dividends for many decades. Okay, so that's what's important. Look for those kind of companies. Also looking for a company that's increasing its dividend. So the company's growing, it's paying out the dividend. So it's not only getting the dividend income, is that increase in that dividend income every year also important. So also be careful of companies that have a payout ratio that's more than 80%. You want to look at a company that's paying out less than 80%. So this obviously highlights a company that might be borrowing to make it look a bit more fancy. But also, they might have sold an asset, they might have sold a property, so it's a once-off situation, which is not bad. But you want to avoid a company, as I say, that's recklessly borrowing money to pay dividends to keep their shareholders happy. That's a big red flag. You want to be aware of that kind of stuff. You want to look for companies that have a lot of cash. Those are ideal companies you want to look for. Those are the companies that are in good shape. You can use a financial ratio called the current ratio, or it is that the current ratio is the current assets to liabilities. As long as it's greater than 1, it's a company in great shape. Okay. You want to look for a company that has share price stability. Obviously, the more volatile the company is, they must scare some people away. But you find that we've seen recently, about 2-3 years ago, no matter how big or stable a company is, the share price will still fall. Going back a few years ago, we saw the beginning of the COVID-19 pandemic back in March 2020. A lot of these big companies, these big blue chip companies, also tumbled, but they also experienced less damage than the total market, and they recovered very quickly. So look for those kind of companies. So some of these companies have better yields in sectors that are experiencing more volatility. Just be aware of those kind of stuff. But the main idea, a prudent investor always has a diversified share portfolio. So you want to have some dividend-paying stocks across various different sectors. Okay, so I'll go through this very quickly. So this is just a quick kind of highlight for you. This is the top 40 index. This is our watch list on Viewpoint. All I've done, I've customized it. If you click on that little button over there, you'll be able to customize it. So I've got the share code, and then I've also added the PE ratio right in the beginning in fixed column, as well as the historical dividend yield. So what I've done in this situation, I've just double clicked on the yield here, just to highlight for you the highest paying dividends. So you can see here, this is Exaro. It's got a historical dividend of what's that, 16 or 18%. I can't see my eyes are blind. You can see Sibanye is sitting on a 12%. But you can see most of these stocks up top here are resource stocks. But just be wary when you start just looking at dividends. Don't just go blindly on dividends. It doesn't automatically indicate a good company. It also doesn't equal lower risk. So you have to look at things, especially with the resource stocks right now. Be wary. You have to answer that question: is this sustainable? You have to be aware that there's obviously less demand for some of these commodities right now. Going forward, what will their profits be like? So what I like to do, and this is something you might want to consider, is having just exposure through one share to a basket of stocks like an ETF, the SATX Resi. For example, the SATX Resi gives you a dividend yield of 7.42%. So it's a basket of all those kind of companies. That's one way of looking at it. So the SATX Resi. You can also look at the SATX Divi. Now that gives you a 4.67% dividend yield. Now what I would be looking at, and that leads on to the next slide, is the SATX, the property ETF. That's giving you a whopping 13.4%, 13.14% dividend yield. So you're taking just those three stocks alone, the average will give you an 8% dividend yield. Okay, so let's talk about property. And a few years ago, those who've been around for many years, we used to have a sector, or obviously the property sector used to be broken down into what we call the property loan stock companies, or the PLSs, and then we also had the property unit trusts, or the puts, and that was all converted into what we call the REIT structures, the real estate investment trust structure. And that was way back in April 2013, so it's nearly 9 years ago. So basically what it is, REITs offer investors exposure to the property sector. So the REIT is a business that owns and manages a real estate property, and obviously pays out the income from those properties to its owners. So in fact, REITs are legally required to pay out a minimum of 75% of the taxable income as dividends to shareholders. So who is this suitable for? I would say anyone that wants to, have exposure, that likes the idea of owning property, but as I say, don't like the idea of managing yourself. That's number one. And number two, obviously people that want exposure to the property market without having a large initial capital investment into it. So be aware of that kind of stuff. So there's a lot of advantages here. Just understand that, remember, they are paying out the interest income or whatever, the rental income they're getting to you as a shareholder in the form of a distribution. So it is taxable. In the past it wasn't. So you still, that dividend withholding tax of 20% is still applicable for these, but these have high ratios. Okay, so guys, I know I've gone overboard again time-wise. So just a quick summary. Sorry, some get some water here. 3 things. Budgeting helps you to align your spending with your goals, improve your debt repayment strategy. And the main idea I wanted to focus on today was just to achieve your saving and investment goals. And I wanted to highlight that money management system. Just think of it as mini goals. Okay. Then lastly, obviously, there's, I mentioned just now, in this context today, we're talking about investing in shares. One way of looking at it is investing in dividend-paying stocks. This is a very straightforward stock picking strategy. Also consider the property sector. It is considered an income yielding asset. So it's saying, and I know some of you guys might be thinking of this. The property sector, it has underperformed in the past 6 months as a result of obviously volatile global markets and rising interest rates. But it looks set to end this year solid, obviously, as this whole pandemic is put behind us, and the sector is, as I say, comes back into favor. So the main idea here also is that people are starting to go back to the malls and people are returning their offices. So this is a sector you might want to start looking at adding onto your watch list, although the income is still expected to be under pressure. So remember, again, in the context of a diversified share portfolio, you might have some exposure to, as I said, the SATX property ETF, but again, have a long-term view. Okay, so I hope that you realize that budgeting, it's just good money management. That's what it's all about. You worked hard for your money. You want to work hard for you. So I also hope that you realize that you cannot work just on one income stream. Get your job as a salary, as a salary. You need other income streams. They say that the average millionaire has up to 7 income streams. So I hope from today's presentation that I've just planted the seeds that you can start creating other passive income streams for yourself. Okay. So in conclusion, I've spoken mainly today about obviously shares, but one way of looking at it is using those mini goals. You can create what we call a voluntary investment account, voluntary investment plan, and that's where you set up your emergency fund and your holiday fund and your whatever those funds were. Use that as one vehicle. Okay. So all these are all links to what they call key innovation documents. Gives you more information about those vehicles that you can use for your budgeting and your savings and investment goals. So as I said, this webinar recording will be sent out tomorrow. Please share with your family. Those of you that are battling with money and things like that. Plant the seeds of budgeting and why it's so important, especially those of you who have children. Use that also as a vehicle. Okay. So guys, from my side, let me see what questions there are, and then we'll tackle, as I say, if you want to get hold of us, there's our wealth box at psg.co.za. You can also get hold of us through OneStream on 0868 000 368. Okay, cool. So guys, I sincerely apologize for going a bit overboard. Let me see what questions you have. Okay, so yes, I refer to money jars. I remember a few years ago, I used to take these Jacob coffee jars, and I physically used to put my children's pocket money into those jars. That's one way of looking at it. It's just a analogy I used. Okay, so I just think of it as different accounts. Let me just maximize this quickly. Lots of questions here. Awesome. Yeah, I'm sorry if my sound is not clear. Okay, looks like everybody else is okay. Sorry about that. As I say, hopefully the recording might come better. Ruth, government bonds, I don't know much about them. Obviously, you can get exposure to a whole lot of different diversified income streams through unit trust. That's one way to look at it. I suggest just do some more homework on them. So I can't really answer your question on government retail bonds. Sorry about that, Ruth. Where would unit trust fit into the 6 money jars? Vessel, again, as I say, you can use each of those money jars, especially that long-term savings. That particularly would be one of those money jars. Emergency fund would fit into a unit trust account. That holiday fund that you're planning to go in the next few years, etc. Okay. Are there any type of investment that children can invest in? Graham, great question. Again, that voluntary investment plan is a good way to start. You can open the account on their behalf with them as being their name and things like that. You just contribute towards it. Okay. Leon, yes, to answer your question, yes, we still use IRIS at PSG. That's that viewpoint I was talking about. Okay. What other questions here? Here's a question here from Candace. Rates, obviously the dividends, are they taxable? Yes, dividend withholding tax applies. As I mentioned just now, obviously the company gives them more leeway, and they have more tax efficient structure, but in your hands as the shareholder, obviously you're paying a 20% dividend tax. So I will answer your question, Candace. There's a question here from Jan. What budgeting method would you do? I suggest I teach my child. Great question again. I suggest a bit of a combination between that envelope method, those money jars, those coffee jars I was talking about. Get those Nescafe glass jars or that Jacobs jars, and use that method with that 50, 30, 20. They might change it a bit. It's flexible. They might decide, okay, instead of having those kind of ratios, let me use 70% spending, 20% for saving and investing, and 10% for giving or tithe. So this example, I wouldn't know offhand what children are earning now as pocket money. Let's say we're giving them 500 Rand a month. based on those ratios, 70% on spending is 350. This is where they buy their clothes and their sweets and things like that. You might take 20% for saving, that's $100. And also, obviously, 10% might go to tithing. Break it down a bit further on a weekly basis. They can give their money in the collection box on Sunday. But the main idea is, 20% doesn't sound a lot if you're talking about 100 Rand. But now you start in the bank account and you teach them the basics about a bank account. And from there, take that money now, put into a voluntary investment plan, and teach them the magic of compounding. That's where it all starts. Okay. Okay, Melinda, my 18-year-old scholar wants to learn how to trade. Must he register as a taxpayer? No, obviously not. So what you do is you register online. When it comes to the tax number, you have to put in a whole lot of different zeros. When it comes to the FICA requirements, obviously you just sends in an affidavit that he's a student or scholar, he doesn't have a tax number, etc. Okay. So I hope that answers the question. Melinda, if I can just give you a word of advice, just be aware with a share trading account, especially with PSG, we don't have a minimum investment, but you must take in consideration that trading costs. Our minimum trading cost now is 154 Rand plus VAT, so it's around about 180 Rand. So if you're going to start with 1,000 Rand, you must understand that your share must go up 18% just to break even on dealing costs. So just be aware of that. Ideally, you're going to start with 20,000 Rand. Your cost is about 1%. You can easily move up 1% in one morning, break it even on cost. But then all your eggs in one basket. So in your situation, I suggest maybe start. You can go registered, open up a share trading account. Don't put money in the account. You'll have access to the platform and things like that. You'll have access to the research. Things like that, you'll access the watch list and technical analysis. But I sincerely recommend that he starts, create a voluntary investment plan, have exposure to the equity market, and then build up capital that way. And when he has enough capital, then move it over across to his equity account, and then from there, build a diversified share portfolio. In the meantime, through this unit trust account, he understands through the fund tax sheet what are the underlying investments, etc. That's why I suggest you start, Melinda. I hope that makes sense. So, guys, I'm sorry it's gone really overboard from my side. As I say, thanks for being on this webinar. Until next month, bye for now.